Welcome to The Explainer. Just a quick heads up before we get into the weeds today, everything we talk about is strictly for educational purposes to help you wrap your head around market mechanics, so definitely don't take it as financial advice. Okay, let's dive right into this fascinating exploration of how time in the options market doesn't just tick steadily by. Instead, it bends, it accelerates, and sometimes it completely collapses. Today we are looking at the hidden clock of the market, Option Theta.
To totally demystify these complex mechanics, here is our game plan. First, the melting ice block. Second, the math behind the melt. Third, the gamma-theta trade-off. Fourth, market quirks and zero DTEs. And finally, hitting the sweet spot.
All right, part 1, the melting ice block and the reality of nonlinear time decay. Let's start in the real world to ground our understanding of what this actually feels like. Picture this. You're holding a massive block of ice right out in the blazing summer sun. Now, if that block has, say, 90 days before it completely disappears, you barely notice anything happening on day 90, or day 80, for that matter. At 90 days out, it's just this slow, boring drip. You kind of forget it's even melting. But fast forward to the last 20 days, it is literally gushing water. It melts more in 5 hours near the very end than it did across 5 whole days at the beginning. Well, in trading, that ice block is an option contract. In quantitative finance, the melting speed, we call that theta. Structurally, options are modeled as wasting assets that constantly lose their extrinsic premium as they creep closer to their expiration date. So, assuming all other variables, like the underlying stock price and implied volatility, just stay perfectly flat, theta represents the daily erosion of that premium. Time only moves in one direction, right? Which means that extrinsic value is just constantly, inevitably decaying.
And honestly, this brilliantly illustrates the difference between standard time and the options market. Most of us just assume time ticks away in a straight line, one tick today, one tick tomorrow. But instead of a straight line, theta acts way more like a playground slide. For the first 2/3 of the slide, it's almost flat, you're barely moving. But the real drop, the sheer, terrifying cliff, happens right at the very end.
Moving on to part 2, the math behind the melt and Black-Scholes dynamics. Let's see how we actually translate that playground metaphor into rigorous, continuous time market math.
When we look at the empirical data for an at-the-money or ATM option, you can see the daily decay accelerating nearly 9-fold in the final hours. We're talking about a jump from negative 0.03 at 60 days out all the way to negative 0.30 with just half a day left. In the Black-Scholes formula, the secret mathematical catalyst for this crazy nonlinearity is actually the square root of time sitting right there in the denominator. As time to expiration approaches 0, that denominator shrinks, which causes the rate of decay to expand wildly, building into this dramatic hockey stick curve. Oh, and notice how gamma is just surging right alongside it?
So the absolutely crucial point here is that your position on that curve is completely dictated by moneyness. ATM options hold the absolute maximum amount of extrinsic value, so they face that wild hockey stick acceleration. But in the money, or ITM options, they behave totally differently. Their intrinsic value is completely insulated from time decay. Because of that, their gamma actually collapses to 0 as they approach a delta of 1, and their decay hits this very stable floor driven almost entirely by the cost of carry. Things like interest rates and dividends. Meanwhile, out-of-the-money options are approaching 0 in absolute dollar terms, but their percentage decay is ridiculously high. You could literally lose 20% of your remaining premium in a single day.
Which brings us to section 3, the gamma-theta trade-off, or, as we like to call it, the cosmic trade-off. Let's descend a little further into the mathematical engine room of the Black-Scholes equation to uncover this fundamental reality of the market.
When you simplify the Black-Scholes equation for a delta-hedged portfolio, you get this beautiful mathematical identity. Theta and gamma are inversely proportional. Since gamma is guaranteed to be positive for a long option, theta absolutely must be negative. Because these two variables are tied together inversely like this, you are facing a cosmic financial trade-off. Essentially, you are always paying time rent to hold explosive potential.
This duality sets up two very distinct battlefields. On one side, buyers slowly bleed out, paying that daily theta rent, just waiting for a massive volatile spike, where positive gamma will exponentially accelerate their profits. Sellers, on the other hand, structure their portfolios to harvest that positive theta as steady, daily income. Sounds great, right? But in exchange for that income, they have to stand directly in the path of the negative gamma wrecking ball.
Any sudden, sharp price gap in the underlying asset is going to accelerate their losses exponentially.
All right, Section 4, Market Quirks and Zero DTEs. This is where the market literally bends time. Once we grasp that core gamma-theta duality, we can start exploring how these formulas warp reality when the market closes for the weekend or when expiration is literally just hours away.
A massive quirk in the options market is the weekend effect. Standard pricing platforms use calendar days, assuming a 365-day year where time just decays uniformly, tick by tick. But obviously the market isn't open on weekends. If a model expects 3 full days of decay over a weekend, but the market only empirically delivers 2, Monday's option prices will look artificially high. This forces the software to artificially spike implied volatility just to make the math work out. To fix this, institutional market makers use a blended 308-day model to dampen those fake swings, essentially valuing a weekend as 1.25 business days. They also actively compress Friday afternoon premiums to price in weekend decay early. So no, traders can't just capture free money over the weekend.
Now, the ultimate bending of time happens with 0 days to expiration, or 0 DTE options. When you look at 0 DTEs, that temporal decay is brutally, violently compressed into a single day. During the morning session, decay is relatively flat, but hit 2 o'clock in the afternoon, the hourly rate of decay approximately doubles. And by the 3:30 p.m. closing bell, it is moving at warp speed, accelerating 4 to 5 times its morning speed.
This intraday hyperdecay forces some massive inelastic delta hedging by dealers. See, market makers are holding huge inventories of short options. If the market stays within their gamma-theta break-even range, the rapid decay perfectly pays for their hedging costs. But if the market moves sharply, they're forced to aggressively buy or sell shares to neutralize their risk. And this dynamic can actually pin the asset price to high-interest strikes. Quants use what's called a pin score based on 4 specific things: open interest, spot price proximity, time to close, and gamma magnitude to predict exactly where dealer hedging flows will physically pull the stock price right at the end of the day.
Which brings us to our final part, Section 5, hitting the sweet spot. Let's pull you out of all that 0 DTE chaos and provide a highly strategic way to actually apply everything we've covered today.
You might be wondering, if decay is so great for sellers, why not just sell options 90 days out and chill? Because time is risk. Since holding a position means exposure, sitting in trades for 90 days on the super flat part of the curve forces you to absorb massive overnight risk for just tiny little drips of profit. Every extra day your money is on the table is another chance for a freak storm, like a sudden news event or an overnight crash, to wipe out weeks of slow progress in about 5 minutes.
So how do we optimize this? By executing 3 precise operational rules. First, stop selling 45 to 60 days out where capital velocity is totally dead. Second, target the 18 to 21 day window. This is the exact inflection point where the slow drip turns into a heavy pour, letting you capture the absolute fastest part of the melt. And third, exit before the final 3 to 5 days. You want to step away and take your profits before the market turns into a freight train of unpredictable gamma explosions.
It's honestly an incredible look into the secret mechanics of the options market. You really aren't just trading price, you are literally trading the decay of time itself. Knowing this leaves us with a pretty massive question. Now that you understand the math behind the melt, how will you navigate the fine line between the slow drip and the sheer drop of the slide? Thank you so much for joining me on this explainer, and I'll catch you next time.